It's been almost 2 decades since we started our journey to educate and help you take action so you may better manage your financial future. Our goal is to help you accomplish your life's purpose. This podcast reveals financial tips, strategies, and insights that will help you to set your financial goals and guide you along the way. This is Managing Your Financial Future, brought to you by the advisors at Lucia Capital Group. We are back. Thank you for joining us. Johnny Dean, your moderator, podcast host, not an advisor. I should throw that in. I feel like hanging out with you, Professor Plum. You've got all the degrees and not the degrees. You've got the designations. You're the Certified Financial Planner Professional.
Yes, I am.
Between the two of us. That's you, and I am the podcast host. But I've learned so much hanging out with you and hanging out with all the other folks at Lucia Capital Group. It's been quite a journey, as I think I may have put in the open of this podcast. For me, learning as much as I have over I am now at 30 years of hanging out.
Yep. Yeah. I've been 28 years with this company.
Right. Yeah. And longer than that. And I know
longer than that in financial planning.
Yeah. Yeah. Not that we have to give our bona fides every time, but for me to just this is proof that just hanging out with people who talk about this stuff all the time and learning about this and things like listening to this podcast can be a big help. A big help.
Well, we spent 2 or 3 hours a day. For the past, up until just recently, taking phone calls from all across the nation on topics of all over financial planning topics, and it was an education every day for both sides. I mean, we did a lot of research to get the answers, and it was fun, but very educational.
Just knowing what was on people's minds. And as I go through some of the eras, remember in the late 90s when we were doing the show, we did a radio show in the late 90s, early 2000s.
In the Bay Area, it was one of our bigger markets.
San Jose, California. It was an afternoon show specific to that radio station.
Right.
We had a morning show that went all over the country, but this was just an afternoon show. And I'm telling you, during that .com bubble, do you remember those calls we would get? Hey, Professor Plum, I've got a 800 square foot house that's worth $2 million, and it's
next to the freeway with bars on the windows.
Right.
But, how do I handle the taxes on this?
And I've got $9 million worth of stock options, and I'm thinking of doubling down. I mean, it was insane. But you know what I'm seeing? So we saw that. We saw there was a real estate bubble that we also saw.
It was a real estate boom at the time.
A boom that went bust, which I guess...
It happens. We saw it again in the mid-2000s.
Well, that's what I'm talking about.
2004, 5, 6.
When we got around 2004, we had calls, because we had a Las Vegas radio station at the time, and I remember getting calls from people, just like
ordinary people,
like waitresses. And I'm not disparaging waitresses, but they don't make a ton of money. But there was one I remember that she says, I've just bought 2 homes, and I'm thinking of flipping them, and I've got 0.25% interest rate that's good for the next year. But I'm thinking now of buying a third. What do you think?
Right. And where's the money going to come from? Well, all I have to do is sign the document. The house isn't even done yet.
Yeah.
I don't even have to start making payments. And I'm going to sell it before it's finished. So I'm never even going to take possession of it.
Going to flip it. Don't even need any money down. I lied on my,
I told them it's $1 million house. And I have to be able to qualify for $1 million loan. But, they're not asking any real questions.
Nah,
the old ninja loans. No income, no job, you can still get the loan.
That's exactly what it was. You had a body temperature roughly in the 90s, you could get a loan. But we saw that back then. So we've been through these different eras. Now, I'm not saying we're in that now, but I kind of think we are with regard to real estate. Now, it's not the same as it was back in 2006. You're not seeing, neg-am mortgages necessarily.
And qualifications are much more strict, as far as being able to get a loan.
Yeah. So all of that, thanks to the laws that were put in place, I think, which are helpful. You're not seeing that, but what we're seeing right now is similar to what we saw, and I remember this back in the mid to late 70s, certainly in California, and I was living in California at the time, where we saw prices double over the course of just I'm talking about home prices,
right?
Real estate prices, home prices double. And we're kind of seeing that now because supplies are greatly limited. Zoning laws, I think, and
the cost of building new is way up. I mean, lumber prices are way up.
Yes, we saw a slowdown in the supply chain during the COVID era, and it hasn't caught up. So naturally, you're going to see you're going to see. I don't want to call it a bubble because I don't know that that's what it is.
Price increases.
Price increases. So what we see, and this is what we're going to talk about here on this podcast, some of what I'm seeing, Professor Plum, is people wanting to get in, as they often do, as prices go up. They want to get in and ride this thing up.
Well, of course, everybody wants to be in when it's going up.
And what we've seen over the last couple of years is stocks, especially since we saw that big drop last year for about a month, maybe 2. I don't know how long it was, but it was very short. We've seen a rebound, and people have money now, many cases, in their IRAs and their 401ks.
Well, in their investment accounts.
Their investment accounts. And so what we have in combination, I want you to talk about this, is we have people with money, and a decent amount of money in their tax-deferred accounts. Let's call them IRAs.
Well, that's where a lot of people have the bulk of their money. A lot of our money if we have it in our personal account, it goes towards current life. We spend it on the bills that we have. The money that's in our IRAs, we allow to grow, and we can't touch it, which is why we have IRAs.
Exactly. That's
and 401ks,
retirement account. Yeah.
And we get that penalty wall and taxable wall between us and the money.
It's like a big guard dog.
So we don't spend it. So a lot of people have a lot more money, and they're looking at, I'd really like to buy a property right now. It's just that I have maybe $10,000 in my savings account, and everything else that I have, I've got a good, 6-figure, whatever number in my 401k, my IRA, and if I could just use my IRA to buy the property.
Well, so what I'm seeing, and I've done a little bit of searching just as pretending to be a novice type person in this, and what I'm seeing is, once again, suggestions that people purchase their real estate inside their IRAs.
And it can be done. Now, it cannot be your primary residence. It cannot be a personal property that you use for vacations and things like that. You can't use it, but you can buy an investment property.
Like a rental home?
A rental home in your IRA. That is a legitimate, legal, acceptable investment for an IRA.
Yeah, so I think
is it prudent is the question.
That's the question. Is it a good idea? And we've talked about this on that radio show that we mentioned, and I wanted to bring it up here on the podcast because there are benefits to owning real estate personally. But if people look and they say, well, all the money I have is in my IRA, and I really, really, really want to buy this rental home, let's call it, this rental property, they get talked into, in many cases, into purchasing this in the IRA. Professor, I want you to talk about this, if you would. Are there benefits to it? And certainly there are drawbacks to it.
Well, there are benefits to it because, like we've just said, that's where the money is.
It's in the IRA.
It's acceptable to do it. Now, buying it in the IRA has some benefits. I mean, in that if I had if you could find a place for $200,000, okay, $500,000.
Yeah.
You buy a place for $500,000. You have $500,000 in your IRA, and you can. It's going to be sheltered. The income that you receive from it. It's basically liability protection for you. That if something goes wrong, they can sue your IRA and get all the money in the IRA, which is the house, but they can't get anything of yours. If I own it personally, I could potentially be personally liable for things. So it's a form of liability protection. So there are some advantages, and that's where the money is. That's the biggest advantage. That's what people do. Now, the disadvantages sometimes outweigh. Some people see it one way or the other.
I personally, because we've talked about this before, the disadvantages to me outweigh the advantages. But you tell me.
Well, one of the big advantages for the average person buying a rental investment property is that they can shelter that current income anyway through depreciation, and so you don't get that with the traditional owning it inside the IRA. Another issue is leverage. If I wanted to buy that $500,000 property, I could put down 20%, and leverage the other $400,000 using the rents and things to pay off the loan, using somebody else's money to pay down the mortgage on it. And so I have less skin in the game, so to speak. And I've got, if the property goes up by 5%, that's $25,000 on a $500,000 house. Well, my 100,000 of equity went up by 25,000. That's a 25% return. So leverage can really enhance that side. Now it can go the other way too.
Sure.
If the property goes down by 5%, I just lost, a big chunk of my equity. But so we look at it as that, that portion of it, leverage can be an advantage. Now, leverage inside of an IRA is much more difficult. I've got a job, I make $150,000 a year, whatever. I can qualify for a loan for $400,000. My IRA doesn't have a job. My IRA doesn't have, and when you're getting a loan inside the IRA for a property, I, as the owner, the beneficiary of the IRA, I can't co-sign for it. They can't look at my income because I can't use my income other than making a contribution of $6,000, $7,000 a year to the IRA. So the IRA has to be able to get the loan on its own.
An IRA has to have a loan.
If you're going to buy property, leveraged property in an IRA, you got to get the loan. The IRA is the one applying for the loan, not you. And so the IRA has to show the income. So you've got to use a lot more of the IRA and other things to show the income. And that's not as easy. So you're typically not going to get the greatest loan. The IRA custodian, usually, because you have to have an IRA custodian, somebody they typically charge a lot more for handling real estate in an IRA because they've got a lot more to do. They're going to have to collect the money. They're going to have to write the checks for the maintenance, for the property taxes and everything. So all of that's got to be done through the IRA.
Now, you said they have to pay, if the IRA owns the real estate, and this is what we're talking about, if there's a property tax bill due on this, if I'm the beneficiary of the IRA, I can't write a personal check for
Oh, heavens no. I unfortunately saw that happen to somebody. They came to us after the fact. They had a pretty good-sized IRA. And it was all under this one custodian, and there was an IRA parcel in it, and the property tax bill came to them, and they just paid it with their personal check. They did not have...
even though the IRA owned it, they paid
the
it.
IRA owned it. It was just it was one of these oversight things where it's like, oh yeah, we just got to pay this, and instead of giving it to the custodian and have it, because the IRA had the money to pay it, they just forgot it, and it basically disqualified the IRA so that whole IRA now becomes taxable. Yeah. Now I think they were able to treat it as an what do they call it? Excess IRA contribution because it was under the $6,000 mark, but it's still, they had to do some fast work to be able to avoid a huge tax problem.
And penalty potentially, I guess.
Well, they were old enough that there wouldn't have been a penalty.
Okay, but maybe some people aren't.
But some people aren't. So you can't have anything to do with it, basically. It's all being run through the IRA. The IRA is the owner. The IRA has to do everything, and that custodian charges you for everything they do.
That sounds like, to me, that just sounds like a horrible headache and a hassle, and one wrong step could cost you huge
It
taxes.
happens, but still, having the IRA own the real estate, if you really want real estate and that's the only place for the money, some people will overlook these issues. The other issue is ultimate, taxation. If I buy a property for $500,000 and I sell it for $600,000, now that is if I've held it for more than a year, that's a long-term capital gain. Currently, that's a lower tax treatment than an IRA distribution. And so I'm trading in potential capital gains tax treatment for ordinary income.
So
that growth also in my IRA is part of my required minimum distribution calculation. So the more it grows, the larger my required minimum distribution becomes. So that can be an issue as time goes on.
Yeah, so what you're saying is, let's say I bought a place for $500,000. Let's say I sold it for $1 million. Whatever. I've got $500,000 of gain. Now, I sell it. The IRA no longer owns it, but the IRA has a gain, but I'm not paying taxes on that yet.
But
right?
that $1 million is in your IRA that when it ultimately comes out.
And now I turn age 72.
And it's going to have to come out. And so now your required minimum distribution is based on that $1 million, and you're going to pay tax on whatever distribution you make. Whereas if I had owned it personally, that $500,000 of gain, I sell it for $1 million, I pay capital gains, long-term capital gains on that $500,000, not ordinary income. And it's not part of my required minimum distribution value going forward either.
Yeah.
And so the other problem with it is, let's say I have that property, I paid $500,000 for it, and I had a $400,000 loan. I did interest only. I'm just making it easy math, and it's now worth $1 million, but I still owe $400,000.
Oh man!
And I sell it inside my IRA. I now have a gain in my IRA, a taxable event in my IRA because I sold leveraged property, and 40% of the property was leveraged at the time I sold it, given the math we just dealt with. 40% of that gain is taxable to the IRA at trust rates, which is horrendous. You don't pay the tax, the IRA pays the tax.
So if there's a loan on it, this is what happened. I forgot about that.
Right, you better pay that loan off before you sell it.
Have the IRA just pay it all off?
Yeah, and then you have no loan when you sell it. Now you don't have the encumbered issue.
But if your IRA doesn't have enough money, it's not like you can dump
$400,000 in.
You can't. I mean, the excess contribution notwithstanding. I mean, you can't do that. So I see all these problems.
Right, and so the idea is, also if I own that property in my IRA and I die, it's still in my IRA. It's part of my required minimum distributions. My heirs, assuming my spouse doesn't inherit, they've got 10 years to get all that money out, because that's the way the new RMD rules work for non-spouse beneficiaries. They have to sell it. If it's in my personal account, I get a step. They had to pay tax on that gain too, by the way.
Right.
But, if it's in my personal account, currently step up in basis, they can take their time to sell it or sell it and pay no taxes on it.
Yeah, so I see the difference between the two, and to me, the benefits of owning real estate inside your IRA are vastly outweighed by the negative aspects, simply because of what looks to me like the benefits of owning it personally, most of which you lose.
So the idea is, how do we get the best of both worlds?
That's my question. Now, I want you as a strategist to tell people. So here's our situation. There's a $500,000 property or whatever that I want to buy, and all I've got, I don't have enough personal money, but I've got, let's say $500,000 in my IRA. And I've just been listening to this podcast, and I think, well, I shouldn't own it in my IRA.
But I still want to own it.
But I still want to own it. Gee, is there anything I can do to get this IRA money to have it allow this money to purchase this property for me?
And some of the answer is, well, obviously the answer is always, it depends. When it comes to financial planning, that seems to be the main answer. It depends on how old you are and whether you can scrounge up enough money for a down payment. But if you can either scrounge up enough money, so maybe instead of using the entire IRA $500,000, if you can't get the money anywhere else, maybe it is worth. Now, I'm not saying this is true for everything. You take a distribution of $50,000, pay the penalties and the taxes, whatever the case, and now you've got some down payment, and then leverage the rest of it, but own it personally. And then what you can do, depending on age. Now, most of the time when somebody has $500,000 in their IRA, they're in their late 40s or 50s by this time. It's rare that a 20-year-old's going to have that much in there.
Yeah.
And so they can set up a payment plan from their IRA that is a structured payment. It's based on their life expectancy, but you can take a payment and it will avoid the penalty. It's 72T. And that usually will be almost enough, maybe a little bit more than enough, to pay the payment on the mortgage that you're paying on the property.
So to back up, what I've done in this example, I have $500,000 in my IRA. I decide, let's say I'm 50.
I've scrounged up enough money to put money down, and I buy the property personally, and I take out a $400,000 loan. Personally,
and
all done personally.
I haven't done anything with the IRA.
Not yet.
Yes.
Maybe I take a little bit out just to give myself a little bit better down payment. Those are numbers we can squeak on. But let's just assume we don't do that yet. But we've got the $500,000 in the IRA. We set up a 72T payment, and we're going to get a couple thousand, $1,500 a month, whatever the number is, and use that towards paying the mortgage.
Now, am I going to be taxed? So I'm now taking, I'm 50. I have to, for the next, call it 10 years,
right?
You're
going to take money out of your IRA. Because you've done a structured payment and we've done the math the right way and satisfied all the IRS requirements, there's no penalty. But it is an IRA distribution.
And it's taxable.
It will be taxable. But you've got this place rented out, you've got depreciation, you've got expenses. You're going to be able to offset that taxability just by the cost of running and maintaining the rental property.
In this example.
In almost every example that we're dealing with rental property.
Yeah.
And so it becomes almost a moot point in that point from a taxability standpoint. And now we own it personally. We get that depreciation. We get all the costs and the benefits of owning it personally, but we're in effect using the IRA money to pay it. And then having the renters pay us personally back for that risk as well.
The money's coming out of the IRA. The IRA is essentially paying for it. Taxes are being mitigated, as you just said, by the rent that you're getting. Now that
by the depreciation.
The depreciation. The rent is still income to you, of course.
Oh yeah. So I mean, that's not a problem. I'm getting income. It's what it is.
Well, income is always good. So in this case, you also, if you decide to sell the property, if, you bought it for $500, and then 10 years from now it's worth $1 million. In this example,
I pay long-term capital gains on the sale. Currently, a significantly lower tax bracket than what ordinary income would be, and so I don't have to deal with dealing with IRA required minimum distributions, and I can sell it now. If I were to sell it in your example that we had a 50-year-old, we sell it in 5 years, I can take that money and do whatever I want with it, because I sold it personally, not in my IRA. Now, I do have to continue making those 72T payments until I'm at least 59 and a half in this example.
So the money's still going to come out of your IRA.
Right, because I don't want to violate that side of it. Yeah. But I just sold, heaven forbid it was that $1 million property you sold. I don't have to stay within the IRA. I can do anything I want with it. I can even use that to retire early. I don't know. Maybe.
Well, you have it, and that's all. You wouldn't have gotten any of that by owning the real estate inside your IRA.
No, it's now still in the IRA. So it's just a matter of what works for you. Now, some people will still want to buy in the IRA because in some cases that's going to work for them. But if we can find a way to use the IRA money and still buy it personally, we still get all the personal benefits. We still get the better tax treatment. We still get the ability to, not have to deal with required minimum distributions on all that gain. We don't have to worry about selling encumbered property and having a tax at trust rates at the IRA level, and the IRA file its own dadgum tax return.
Oh, yeah. That's another expense.
Those are all things that we don't have to deal with in this situation.
Because we own it personally.
But we're still using the IRA money to pay for it.
Now, let's say after 10 years, in my example, it's now worth $1 million, and I say, well, heck, if I sell it, it's capital gains rates, but I'm still not a big fan of that. Can I kick the renters out after 10 years or whatever and move into that property?
Well, you can.
And potentially sell it?
No.
We used to be able to do this kind of thing.
Yes, but they have changed a lot. About 10, 12, 11 years ago, they changed the rules on the primary residence exclusion.
Was it in 2010 or 2008?
2010.
But it was post-2000. 2008 had something to do with it.
I think...
I don't want to get into it because it's...
But it's time that it was not... Time of ownership where it was not your primary residence after 2008 that counts against you. So in your example, let's say you kicked them out in 10 years from now, lived in it for 2 years and maybe a day, and sold it. Now you've lived in it, or you've owned it for 12 years. You've had it as your primary residence for two. That's what, 18%?
1/6?
Yeah, I think it's about 18%. Yeah. That means 18% of the gain qualifies as primary residence exclusion. So in this example, $90,000 of that $500,000 you can exclude from taxation. The other $410 is still going to be taxable.
It may not be worth it to do that.
Yeah, and unfortunately, that law creeps up and catches a lot of people by surprise. Even though it's been around for 10, 12 years now.
They don't know about it.
Yeah, because when we first got the rule for the 2 out of 5 years, there wasn't this portion of the rule. They added it 10 years later because when it came out, we could have 50 properties and live in each one of them for 2 years, sell it, and as long as we lived in it for 2 years of the 5 years before sale, and we didn't take the gain or have a sale within 2 years of each other,
which you wouldn't,
we could exclude up to $500,000 for a married couple every 2 years and 2 days.
Oh, people used to do that, as you said. 50 is too many, but you could have 3 or 4 and just I'll kick the renters out, move in, sell that, capital gains tax free,
up to $500,000. Well, $250 per owner
if you're married, right? Yeah. And do that right down the line. So they've changed it a little bit.
That.
They don't let people do that. But, I wanted to bring that up because owning a real estate personally currently, here's something else a lot of people don't know, primary residence, and this law has been in effect since 1998, 97.
Which one
was that
this?
May 7th?
That's the primary residence exclusion
the
rules.
Primary residence exclusion. I'm surprised that a lot of people don't know this, but Professor Plum explained that very quickly.
Were you talking about the depreciation? Or
no, the ability to exclude up to $500,000 for a married couple from taxation of a primary residence.
Yeah, back in 1997, the old rule prior to 1997 or 1998, was that once you turned age 55, you could sell your primary residence and exclude up to $125,000 of the gain. If you were not 55 and you didn't want to pay taxes, you had 2 years to buy another property of equal or greater value and roll the gain into that new property. Kind of like a 1031 exchange, but it was with primary residence.
And it was 2 years.
And it was 2 years. You had 2 years to buy another property of equal or greater value. Well, what they did was they said, we like the idea of a 2-year time window, but let's make it 2 years of ownership. And if you sell your property, if you've owned it for 2 years of at least the last 5 years preceding sale, and you sell it, you can exclude up to $250,000 of gain, and you don't even have to buy another property.
You can pocket it and say,
do whatever you want. There's no requirement. When you sell a primary residence, if you exclude the gain, you don't exclude the gain, whatever, you do not have to buy another residence to exclude the gain, that $250,000, $500,000 for a married couple exclusion. Mm-hmm. There's no requirement you buy another property. Now, most people will buy another property, but maybe they don't want to buy one right away. Maybe they're moving out of the state where they worked and they got sick of the politics and the taxes and everything, and they're moving to another state, and they want to kind of test the water in different neighborhoods for a little while, see where they really want to live. And it'll take them more than 2 years to do that. Mm-hmm. And so there's no requirement you buy another property that when you exclude the gain on a sale of a primary residence.
You can pocket the difference and do whatever you want with it. Yep. And in some cases, people are doing that very thing. You know, they'll be in a high property state,
high property
value state, sell it, for $500,000 more than the basis, and take that $500,000. Put $200,000 down for a cheaper house and do what they want with the $300,000.
We're seeing that a lot within certain states where there are certain areas of a state really exceptional.
Yeah, that's true.
Bay Area.
California.
And they're moving to other parts of California now that they're realizing that they can work from home or work remote.
Oh, yeah.
And they don't.
I knew somebody move up into the hills of way northern California, up where the redwoods are.
But you figure, you're living in the Bay Area. The average house is like umpteen millions of dollars, and your mortgage is through the roof, and you find out that you can move to a different place in California, still be somewhat close to the coast or whatever, mm-hmm. And have a mortgage that's a third of what you were paying there, and pocket some gain. People are doing it.
And this is all the result of somebody owning their real estate personally within the IRA, which is the point of the theme of this particular episode. Right. Owning it in the IRA, most of that, if not all of it, those benefits go away.
Right. And we were in the last part of this podcast, we were talking about personal residences, and that cannot be done in an IRA.
Can only be investment property, as you said. Yes, we said that at the top. It has to be an investment property. Can't be a vacation home.
No, that's a personal property.
That's considered a personal property. Something else a lot of people don't know. So just if all the money that you have is in your IRA to purchase this property, and you really want this property, Professor Plum?
It depends on where you're sitting and how you're doing, but let's find a way, if possible, to buy it personally. Use the IRA if possible to pay for it, but mm-hmm. not buy it inside the IRA.
And if you need more information on that, or you want to talk to Professor Plum, or if you really want to hear that again, you can just rewind this particular episode and listen to Professor's strategy. You can get in touch with him at Lucia Capital Group, 800-644-1150, or one of the other Lucia Capital Group advisors. Sometimes Professor Plum is busy, but he's always around, and he's always you as the Chief Financial Planning Officer for Lucia Capital Group. You oversee the plans that go out anyway. But these are the strategies that they work with all the time. So you get this with one advisor, you can get this with any of the advisors that talk about this. 800-644-1150. I bring this up because so many people, for whatever reason, and I don't know if I'm not going to say it's a good idea or not, but they want to get into the real estate game. They want to buy the properties because they see the values going up. That's not for us to decide whether it's good or bad. But if that's what you've decided you want to do, it could be potentially a good idea if you have the money in your IRA, and that's the only place you have the money to do this particular 72T strategy that Professor Plum talked about. Make sure you follow the rules of 72T. Professor Plum, if you violate the 72T rules, you could wind up paying a tax and penalties on.
Well, you're already paying the tax,
I'm
so
sorry,
it's all
but
about the penalty.
Penalties, yeah.
But you would pay penalty retroactive on every one of those distributions you take it. Don't wait 10 years, because then you've got 10 years worth of distributions you owe a 10% penalty on.
Yeah, so if you want to know about 72T, you can ask Professor Plum or look it up. But again, 800-644-1150. This is all part of people's ordinary, oftentimes part of their ordinary retirement strategy. There are people who have rental properties and they're not sure what to do with them as they approach retirement.
We've getting a lot of questions of, should I get out of it now? I mean, it's been a good run. Certain states are putting a lot more protections in for renters.
You're getting timing questions on this?
We're getting headache questions. They're worried about the protections and the difficulties for getting renters out, or for dealing with renters, and they're like, I'm getting sick of this. How do I get out of these? and
it's not always
can
easy.
I get a good return somewhere else?
Yeah. Well, these are things, I mean, we don't really do timing issues because who knows? Nobody knows. But it's all about strategizing. And if you could put a strategy together, I think generally you're going to do better than somebody who does not have one. 800-644-1150, or go to luciacap.com, LUCIACAP.com. Out of time. We're going to be talking next week, I believe, about Social Security. We've had some questions on this.
Social insecurity?
Social Security. There's some myths out there. We've done a couple of webinars about this that I want to tell you about. So tune in next time to find out about the different ages where you can take Social Security, and when is it better to take Social Security. That'll be coming up next time on Managing Your Financial Future. For Professor Rick Plum, Certified Financial Planner Professional, I'm your podcast host, Johnny Dean. I thank you all for listening, and we will talk to you again next week.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. To the extent that this material concerns tax matters, it is not intended or written to be used and cannot be used by a taxpayer for the purpose of avoiding penalties that may be imposed by law. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. Different types of investments and/or investment strategies involve varying levels of risk, and there can be no assurance that any specific investment or investment strategy, including the investments purchased and/or investment strategies devised by LCG, will either be suitable or profitable for a client's or prospective client's portfolio. Thus, investments may result in a loss of principal. Accordingly, no client or prospective client should assume that the presentation or any component thereof serves as the receipt of or a substitute for personalized advice from LCG or from any other investment professional. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. This material was gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59 and a half may also be subject to a 10% penalty tax. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. The information provided is based on current laws, which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. Rick Plum is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor, and member FINRA SIPC. The investment professionals are affiliated with LPL Financial and are conducting business using the name Lucia Capital Group, a separate entity from LPL Financial.